Hi, we're Fifth Harmony, the seasoned investment team at Mosaic Capital Partners. We'll be considering a joint venture partnership investment with 512 Development Partners in Northern Lakewood. I'm Andrew Karras. I'll give you a brief overview of the investment opportunity. Then Lauren Black will zoom out and provide some context for the investment. Next, Alex Gary will walk you through some of the numbers that drive our conclusions before Margot Sulmont analyzes some of the alternative scenarios that could affect our bottom line. Finally, Leah Moe will wrap it all up and present our final recommendation. It isn't every day that an investment opportunity on this scale in a neighborhood this hot with this much value add potential comes across our desks, and that's exactly what 512 has presented us with. We're talking about 1,000 units across 4 legacy buildings in a neighborhood whose economics are fundamentally very strong. Historically, rent growth in Northern Lakewood has been above the national average, and occupancy at about 95% has been very strong. These trends have been especially true after the Great Financial Crisis, and we'll talk in a moment about our level of confidence in their continuation. To the extent that we have any concern with this investment on the front end, it's in setting up that joint venture agreement. With a 50-50 equity contribution split, we're entering somewhat of uncharted territories for Mosaic, because Mosaic is a little bit more familiar with joint venture agreements where we contribute more of the capital and thus retain a greater level of control over execution. That said, from a portfolio diversification standpoint, it benefits us to deploy only 1/6 of our remaining fund equity into this single project. From a timeline perspective, we expect to be able to sell and exit the investment well within our fund lifespan, although we have about a year of extendable cushion before we would potentially have to refinance our loan. The return we've modeled for Mosaic is 12.1% IRR as our core, our central estimate. It's right within our fund target band. The LTV allows us, we could go up to 70%, lever up a little bit higher than the target, thanks to prior fund investments and below target LTV. So when we think about what we really like about this project, the strengths, as I mentioned, begin with the economics. The strong rent growth, strong occupancy, give us confidence that the upside is potentially huge. In addition to offering market rate rentals, we will be we propose to sign an affordable housing agreement with the city, whereby we will rent some of our units at below market rents in exchange for a 40-year abatement against the tax expenses on this property. On top of that, about 40% of our rental income derives from renters holding publicly subsidized vouchers. Those tenants pay market rents while exhibiting rock bottom turnover rates about 3.5%. These 3 income streams help us balance, on the one hand, the strength and growth of our revenue streams, as well as their stability. And it's all possible because of a robust capital investment program that builds upon $60 million in capital improvements under the prior owner during the last 5 years. To the extent that we believe Mosaic is stretching to pull off this opportunity, again, it goes back to the joint venture. But we believe by smartly structuring the waterfall and putting in clauses into the contract, such as a right of first refusal and, right of first refusal and dragging rights, we will be able to avoid entering avoid arbitration and unlock synergy between us and our partner. The opportunity, should rental growth exceed our estimate, is enormous, and one factor that we believe will bolster demand is a potential hospital expansion, which, if it happens, will not only consume some of the remaining and increasingly scarce developable land in Northern Lakewood, it will also attract residents, workers, visitors, and corporate clients, or corporate executives coming into town and directly into Northern Lakewood. Of course, if rents can exceed expectations, they can also disappoint. And so we've made sure to model sensitivities of both cyclical contingencies. Finally, the political risk associated with a gentrifying neighborhood is considerable, and so we believe inking this affordable deal now locks in a deal we can live with as a hedge against uncertainty as the city works out ways to respond to voters concerned about rising rents. Lauren?
Thank you. Before we dive into the analysis of our investment, I'd like to explain to the committee the background and the catalyst for this transaction. Urbanization continues to be a major trend nationwide, and large metropolitan areas are experiencing above-average economic growth. Within the northern Lakewood market, demand for housing remains robust. As you can see here, short-run rent growth is quite volatile, and the cycle may be nearing its peak. However, we believe that there is still opportunity here. Long-run rent growth continues to average between 4% and 5%. Further, affordable housing is scarce, and construction is cost prohibitive. Innovations in the rental market are attempting to address affordability concerns. We evaluated a spectrum of solutions with respect to our proposal, from big data to co-living. We evaluated these solutions on a feasibility scale from low to high, as well as evaluating these solutions with respect to addressing tenants' affordability concerns, again, on a scale from low to high. For example, modular construction could reduce building costs, and those costs could be passed down to the tenants in the form of reduced rent. However, this solution is not feasible in our case, as we are working with an existing structure. On the other hand, flexible full-service rentals offer a balanced approach, allowing us to extract market rate rents while providing space for the affordable housing part of our proposal to work. Public and private solutions are attempting to mitigate the effects of the affordable housing crisis. First, government interventions, like the end to single-family zoning in Minneapolis, push developers to build denser, multifamily buildings. Second, private initiatives, like company-sponsored housing in Palo Alto, subsidize the cost of living for employees in market areas where the rent is quite high. And lastly, public and private partnerships, like the low-income housing tax credit, attempt to incentivize developers to build housing for low and moderate income individuals and families. We believe that this investment presents a win-win opportunity for Northern Lakewood. For the community, our plan supports income integration in a city with restrictive zoning, limited developable land, high rent prices, and a housing shortage. Our plan creates 667 units of affordable housing in an area with good public schools and access to public transit. And our plan contributes to reducing carbon emissions, creating a healthier and cleaner environment for the community. For our investors, our plan decreases property taxes from 20% to 3% over a 40-year period. Our plan generates an ongoing source of income throughout the hold period due to the historically low turnover rates for market rate and for public voucher units. And our plan achieves market rent premiums on our recently upgraded units. In the midst of this affordable housing crisis, our proposal sets an example for multifamily investments nationwide by expanding access to affordable housing while continuing to provide robust returns for our investors. And now Alex will explain the analysis behind our proposal.
I'd like to walk you through the model that we created for this investment opportunity. You'll see in the graph on the left, NOI is steadily increasing over time in about the mid-20s. You'll see that this might not really make sense, though, when you're considering an affordable housing opportunity. But there's two reasons for this. One, there's a very slow turnover rate in the units that we have. And two, the premium rents that we can charge on those units that have yet to be turned over. Through this process, we're able to sustain the affordability piece and slowly work towards that 2/3 requirement over a long run. Here's our cash flow summary, looking through how we have an initial cap rate of 4.9. and we'll be exiting at a 4.75 cap rate. So the value of this opportunity, it's in the sale. We're able to achieve this cap rate compression through the heavy upfront capital on projects like the energy efficiency project, like the cogeneration, and the submetering utility improvements, where those will lead to long-run ROI. We'll be cash flow positive in year 2022 and be able to sell in year 2024 at that 4.75 cap rate, paying off the rest of our debt. This is a great opportunity for Mosaic. It's a bit different, though, than what we're used to because of this equity split. So we have to think about how we're going to structure this deal. When you're looking at it, 512 brought this opportunity to us. And they're the ones that are going to be executing it on the day-to-day. And we need to structure it accordingly. Within the fund's context, too, we have a 5-year hold that meets the requirements. We have the 12.1% IRR that meets the fund requirements. And we have the 1.74 equity multiple that also meets the fund requirements. Within this JV structure partnership with 512, we're dividing the upside and the downside risks. 512 Development Partners, their bread and butter is in affordable housing. And that's where they're really going to shine in this. However, they don't have as much experience in those premium rental units that we'll be converting. So that's where we're going to come in. And that's where we're going to advise them on how to position those assets to best take advantage of this opportunity. As I talked about, 512, they're going to be the ones that are executing on the day-to-day, but we'll still have meetings frequently to maintain that alignment throughout the entire project. We need to consider, too, the strict capital budgeting requirements and the pre-specified amounts that we've had conversations with about this project, in addition to the right to veto any major decisions throughout this project. We can specify all of these within the contract, but really the way to motivate 512's upside, because they're operating on the day-to-day, is going to be through the waterfall structure that we have here. You'll see that with this 50-50 equity split, it starts out pretty even. However, as you continue and move down the tier and increase that IRR, 512 is going to get an increasing portion all the way up to 85%. And that's why we want to incentivize their upside by motivating them to go in, day out, and perform. We'll have Margot talk about the sensitivities.
So Alex just walked us through the pro forma. I'll walk you through the sensitivity analysis that we ran and how they impact our returns. As you can see on this slide, we consider 2 significant components. First, whether or not to continue with the cogeneration improvements. It's at $7.5 million upfront capital investment. However, we saw that with the energy savings and the tax credit, we can actually improve returns and increase our IRR. So our recommendation is to go forward with those improvements. Second, we wanted to test a scenario where we do not go with the affordable agreement. The rationale is that we could boost gross rent income, exit at a lower cap rate, and maximize the value of the renovations. However, from the IRR, you could see that we're nowhere near our targeted returns. In fact, the value of this deal is really the property tax abatement, and that's how we can make this investment possible. This is the financial, aside from the financial implications, it would create misalignments with our operating partner, whose bread and butter is really workforce and affordable housing. We also considered different financing options. We were given quotes for 3 different loan types of different LTVs and interest rates. We recommend going with the higher levered option at 70% LTV to target the returns that our fund needs. And then finally, we wanted to test the assumptions regarding rent growth. Currently, our rent growth is based on the rolling averages that Lauren presented us earlier, so around 2%. But we want to consider an economic downturn and where we could have major negative impacts on incomes in the area. To do so, we decreased the rent growth by 100 basis points just to see what would happen to our returns. As you can see, we're at 10.5%. So this is a risk we have to consider, but we're really confident in this property and this market It's limited competition in a gentrifying neighborhood, so we could actually see upside, especially with a hospital expansion, and we have increased employment growth. In this scenario, where we increase the rent growth by 100 basis points, we see that our returns are in the high teens, further motivating our operating partner. Ultimately, we're confident in the assumptions that we have in this model, and Leah will walk you through some of those implications.
Thanks, Margot. As Margot alluded to earlier, there are some potential risks in this investment, and that's in the case of an economic downturn. While we do not think it's likely, we do want to call out 3 major factors that could potentially risk our investment targets. First, it's in the rent growth rates. Second, it's in our cap rate. And lastly, it's in our cost escalations. We're currently predicting a strong rental growth rate year by year because we're in a supply-constrained market. However, in the event of an economic downturn and an influx of inventory, we could see the rent growth decline or even stagnate, which would decrease our investment returns over the long run. Second, in terms of cap rate, we're predicting a lower exit cap rate than a going-in cap rate. However, with government regulations like rent controls, this could decrease the sale price and increase our cap rate, thereby decreasing the attractiveness of this investment portfolio. The last risk to consider is with cost escalations. Currently, based on the case, we have minimal to none renovation cost escalations as well as capital improvement escalations. We could see in the market with increasing labor costs as well as material costs, there are cost escalations for capital improvements will actually increase and therefore also decrease the attractiveness and return of our investment portfolio. However, we believe that the positives outweigh the negatives in this investment, and we believe that in the short run, we will receive a positive return and hit our investment targets. And this is why Mosaic Capital should partner with 512 to invest in this Northern Lakewood property because of a 12.1% IRR as well as a 1.74 times equity multiple that is in line with Mosaic's target returns. We believe the deal is unique because of the 50-50 equity contribution split between the operator as well as Mosaic. This demonstrates that 512 has a strong conviction in this investment, as well as the fact that Mosaic will have a diversified portfolio with a lower risk in this investment as they're only putting 50%. Second, we believe the rationale for this deal truly lies in the property tax abatement incentive. This not only provides an economic benefit for Mosaic, but also Mosaic is in return able to provide a social benefit for the local community by generating 2/3 of its units as affordable housing. In addition, there is going to be an expansion of hospitals in this area. And the opportunity for this expansion of hospital means a growing demand for visitors, hospital visitors. And thereby, we propose that we create the rest of the 1/3 of its units as short-term luxury apartments. This will allow us to increase our rent rates as well as increase the IRR returns. And we believe there's a demand for this in this market because of the visitors who are going to be visiting the hospital, as well as existing corporate employees who are traveling into the city and need short-term luxury accommodations. Therefore, our investment team believes this is a strong investment and a smart way to do affordable housing. Thank you so much for your time today, and we'll now open it up to any questions. I think for us, the most important thing that we'll not compromise on is in the affordable housing. We'll want to meet the affordable housing agreements because, as Margot previously showed us, that we will be able to generate a positive return, as well as the fact that we think this is going to be providing a social benefit for a community that has extremely high rental rates. And so we want to provide affordability in this market.
And I think the waterfall structure, I think that's really where we're going to make sure we're incentivized and that they're going to complete the project and execute on time and within budget. So ultimately, sticking to those percentages, I think, will allow us to come to an agreement.
Yeah. So in looking at the case and also looking at short-term rental markets in the general market in the U.S., we found that generally the market rates for short-term rentals are between $4,000 to $6,000 per month. And we budgeted that into our model and considered the fact that there's going to be higher vacancy rates, given that it's more short-term stay, as well as the fact that we're going to have to put in higher capital improvements. And so at around a conservative $4,000 per month rent, we're estimating a 20% IRR return.
Sure, I can address that. So we mentioned clauses in the contract that affect the sale. But I think you're mentioning things that would happen prior to a sale. Either the execution doesn't work out or they don't contribute the capital. So to the second point, we have a couple different options. If you look at the literature around the legal case history of these contracts, one thing to do would be to essentially charge effectively an interest on any capital that 512 does not contribute. Again, since we're only contributing 1/6 of our remaining deployable equity, we have some more funds that we could put in to salvage the project at significant cost to us. And so I think that interest is justified. And as we enter a negotiation with 512, I think our stance as a reputation as a very strong capital partner gives us a lot of bargaining power.
Yeah, the way that we want the right to veto major decisions throughout this project. And so we'd be able to structure those out throughout the contract, so it's not really vetoing anything. We want to give them the ability to execute on the day-to-day decisions, and we trust them through those types of decisions. But these types of major decisions would be pre-outlined within the contract, and they'd agree to that, or that's how we would propose the deal.
Yes, I think in line with what the case had said, it would be we'd be cooperating, and we'd be making decisions together as equal partners. So we would give them equally veto rights as well.
Well, in the event of a sale, and we did a little bit of research during the break, so if you'll give me a moment, we certainly want to put in a right of first offer clause. So that the way I understand it, I think if we find someone who's willing to buy, 512 is forced to sell to us unless they can find a more compelling offer. I think that's one way to do it. Otherwise, we can institute drag-along rights where they would be forced to go along with whatever we decide. Obviously, that plays into the negotiation, but I think that's what the promote is for. They get a higher IRR than us in the base case, and I think that's part of their role as a developer. Sure, that's a discussion we can have. Of course, if you go much below 70, I think Mario can talk about this, or we could go back to that slide for the specifics, but it pushes our IRR down. There's probably, I'm sorry, right, there's a number somewhere between 65 and 70. It's sort of a minimum for us. Although if there's a give and take, we can find other ways to make up that IRR.
Yeah, we had an acquisition fee of 0.5%, since it's such a large deal. I don't think 1% is appropriate, and an operating management fee. So they're definitely, we're giving the incentive for them to execute on time and deliver a good project.
I think the idea is really leveraging their expertise within this overall context. Like we talked about, their bread and butter is within this affordability opportunity. And so giving them the opportunity to shine through their expertise, that's where we see them really contributing the value. And while we will provide them with the asset management fee, this is really the way to structure it so that we're able to align, I think, both of our incentives for Mosaic to meet the fund's IRR requirements while incentivizing 512 to perform as best as they can on the day-to-day because of their really strong upside.
And just to call one additional thing out, I know you can see it, but the hurdles are 10 and then 12, 14, and the Fund 5 sort of target IRR band is between 12 and 14. So that's where it really starts to tilt in their favor once we hit 12.
Right, and the reason why we have it more in favor of 512 is because Mosaic is putting in a 50% equity contribution. Usually the contribution from the LP side is between the ranges of 70 to 90. So Mosaic is putting in a lower initial contribution, so we think it's fair to give 512 a higher return once it hits our IRR targets. Yeah, we would do the deal, and that's because in our model with the 12.1% IRR, that has not modeled out the increase in rent from luxury apartments yet. So when we model out the increase in rent from luxury apartments to around a conservative $4,000 per month cost, we'll actually see over 20% IRR. So yes, we would still do the deal without that opportunity. We just think that with luxury short-term apartments, the upside potential and return for this investment could be even larger than what we present here to this committee today.
All right, thank you to Fifth Harmony.